Cisco is currently trading at $60.23, and over the past year they are up by almost 20%. Now, Cisco is actually one of the companies I hold in my portfolio. So if I zoom into my portfolio, you can see that it makes up 8.27% of all of my positions. I bought it when it was trading at $47.23, and currently I am up by about 27.5%. They also pay me about $19 in dividends every single year. But now let's figure out if Cisco is still a buy at its current trading price. So when I jump to my stock valuation spreadsheet, I will plug in the ticker Cisco and wait for all the metrics to show up. Now, as always, if you want to download these spreadsheets for your own personal use, you can do so at the link in the description. Right away, let's have a look at the dividends of the company, specifically at their trading free cash flow payout ratio, which is sitting at 46.16%. Now, for those of you who have watched the channel before, you probably know that for companies such as Cisco, I like the payout ratio to be below 40%, as they are in the technology sector and they have to direct a lot of their free cash flow into innovation to stay relevant. If I zoom into pillar 8 and scroll a little down, you can see that their free cash flow payout ratio has actually been moving around 40% for most of the past 5 years, and only in 2024 did it jump above 60%. And the reason for this is actually a decrease in their free cash flow. So let's have a look at that right now. Jumping to the 9 pillars, you can see that the company gets a rating of 7 out of 9, with 2 pillars currently sitting in the red, and that is the free cash flow growth and the net income growth. Both of these numbers are currently sitting in the negative. Now zooming into pillar 5, that is the free cash flow growth over the past 5 years. In 2024, it dropped by almost 50%, from 19 billion in 2023 to only 10 billion. And that is why the free cash flow payout ratio is sitting so high. Now, if I jump to the net income tab, you can see that that has decreased from 11.2 billion in 2020 to 10.3 billion in 2024. And regarding the revenue, that has grown from 49 billion to 53 billion in 2024. But over the past 5 years, the average growth rate is sitting at about 1.59%. So the company's financial growth hasn't been as great over the past 5 years. Now, the reason why I'm not so worried about this is that the company does expect high growth in AI orders in 2025. So I'm positive that their overall income will see some decent growth. Now, jumping back to the 9-pillar analysis, let me list some things I really like about Cisco. First, they have been decreasing their shares outstanding at a rate of 1% yearly over the past 5 years, and this essentially grows the earnings per share of the company, increasing its value. Their 5-year profit margin is also sitting nice and high at 21.65%. Though if I zoom in closer, you can see that it has been decreasing over this time period, and currently it is sitting at only 17.73, which is more than 4% lower than the 5-year average. And the reason for this is because they are shifting their business towards AI, and this business model isn't yet as optimized. Now, jumping back to the 9-pillar analysis, let's have a look at how much debt Cisco currently has. If we direct our attention to the long-term liabilities over the 5-year free cash flow negative dividends, you can see that this ratio is sitting at 0.64, which is well in the range below 3. And this essentially means that Cisco, with the free cash flow they currently generate, although it has decreased quite a lot over the past year, they can still pay off all their long-term liabilities in about 3 years, which is great. Now, I also want to have a look at the company's low 5-year dividend growth, sitting at only 2.29%. If I zoom in back to pillar 8, you can see that that is lower than the average stock year-over-year dividend growth. Now, I normally aim for the companies in my portfolio to have a dividend growth of at least 4%, as in the long term, I do want to be able to live off dividends, and dividend growth is the best way one can achieve that. If I jump to Seeking Alpha's dividend yield tab and scroll down to the yield on cost tab, you can see that if you invested into Cisco 30 years ago, your yield on cost would be sitting at 82%. That means if you were to invest $10,000 30 years ago into this company, it would right now generate you $8,000 in dividends every single year. And this is the power of dividend growth. Now, the reason why I did buy into Cisco is because at the time when I bought it, it was trading very undervalued, and I saw a great opportunity for a nice return. Now, jumping back to the 9-pillar analysis, let's have a look if the company is still trading undervalued compared to their earnings and compared to the free cash flow they are generating. If we jump to pillar 1, that is the 5-year PE ratio, we can see that that is sitting at 19.08, which would be in the range we would like it to be in. But currently the PE ratio is sitting at 25.96, which is quite higher than the average stock PE ratio, and so Cisco would be considered slightly overvalued compared to the earnings they are currently generating. Now regarding the free cash flow, if we jump to pillar 2, you can see that the current price to free cash flow is sitting at 24, which is again higher than the 5-year average and higher than the average stock price to free cash flow. So Cisco would as well be considered overvalued compared to the free cash flow they are generating. But as I already said, in 2025, the company is expected to see great growth in their AI sector, which should raise their free cash flow as well as their net income, lowering their price to free cash flow and PE ratio. So now that we have gone through the 9-pillar analysis and the company is looking very decent, let's calculate its intrinsic value. So jumping to the Graham's formula revised, I will plug in the high earnings per share growth at 8%, medium at 5% and low at 2%, and averaging this out with the analyst predictions, we will get the 5-year earnings growth estimate at 12.94% yearly into the next 5 years. I will then combine that with all the other values and get an intrinsic value of $69.10, which is 13% higher than the current trading price. Now for the second valuation model, we will turn to the discounted cash flow model. We will take the free cash flow of the company over the past 5 years and calculate the negative average growth rate of 2.5%. Now into the future, I will calculate a growth rate of 6.3%, and using that, I will calculate the future free cash flow. After that, I will plug in a discount rate at about 8% and calculate the present value of that future free cash flow. I will add all of that up, add cash and cash equivalents, and subtract total debt to get an equity value, which I will divide by the shares outstanding and get an intrinsic value of $62.21, which is about $2 higher than the current trading price. Now I also want to compare Cisco to its competitors. So jumping to the multiples valuation, we will compare Cisco to Motorola and Arista Networks. We will take these companies' current stock prices and divide by their earnings per share to get their PE ratios, which as you can already see are higher than Cisco's. We will average these out and multiply by the current earnings per share of Cisco to get an intrinsic value of $126.02, which is more than double the current trading price. Now for the fourth and final valuation model, we want to have a look at the potential dividend growth of the company. So plugging in the dividend growth over the past 5 years, we will calculate an average growth rate of 2.71%. Into the future, I will project a growth rate of 2.5%, as I do want to be a little conservative, and we will get an intrinsic value of $29.75, which is 50% lower than the current trading price. Now moving to the ultimate valuation, we will average out the 4 valuation models and get an ultimate intrinsic value of $71.77, which is 19% higher than the current trading price of $60.23. And with a margin of safety of 15%, we would get an acceptable buy price at $61. So overall, Cisco is currently looking quite undervalued, especially compared to other tech companies. Of course, if you enjoyed these valuation spreadsheets, make sure to download them at the link in the description. And with that, make sure to leave a like and subscribe, as it really helps me out.